They were founded many decades ago. Fannie Mae first in the 30s, Freddie Mac later in the 70s. Actually, they were privatized in the past, in the late 60s, by a previous piece of legislation, which sort of has some echoes of what's happening today. And the companies basically guarantee 70% of U.S. mortgages. Their existence is unique globally, and it makes the U.S. home ownership model possible. And it's the reason that we have a 30-year fixed rate mortgage available to homeowners today.
So what do we need to know about what happened potentially during the financial crisis and the government oversight that we've seen over the last few years, and what could change given what we heard from the president?
Yeah, so the companies are fundamentally changed since the financial crisis. It's important to note that they were doing all kinds of ancillary businesses. They were basically operating the world's biggest hedge fund, as Warren Buffett once said. And they got over their skis, taking on a bunch of additional risk beyond just guaranteeing vanilla mortgages. So the majority of the losses they suffered from 2008 to 2011 were from those activities, right? So they don't do any of that anymore. But they exist in this sort of quasi-governmental state where the FHFA and the Treasury own and are in charge of the companies, and by and large they function very well. They provide a huge amount of liquidity to U.S. housing markets every year. They make the 30-year mortgage possible, and they earn about $30 billion a year for the Treasury Department. So the status quo is arguably working, but they're in sort of a bankruptcy-like process that was never meant to be permanent, and so there are a lot of observers who think that process should now come to an end.
All right, so you've got Fannie Mae up 40% in today's session. Freddie Mac is up just about 39%. So if they do go public officially and they're publicly held entities, what does it mean for them? What does it mean for their role in housing? How might that change things from what they've been?
Well, it's really important to note that there are very few details on this, right? So the president has been sort of saying what he said last night since 2017. So we don't have anything new, and the really important detail will be how, if at all, the U.S. government continues to back these companies after they exit conservatorship potentially and start to trade like normal public companies. And everyone, by and large, agrees that there will be some form of federal government guarantee. They hope it will be explicit. They hope it will be defined at a certain value, and they hope that it will be paid for. But by and large, the companies get a huge amount of benefits from being quasi-governmental. Their credit rating is tied to the sovereign, for instance. So they get very they get financing on par with the risk-free rate, essentially, which allows their business model to function at the prices it does today. So if the companies were to exit conservatorship, it's not necessarily true that mortgage rates will rise, but there are plenty of ways in which they could. One is that the companies choose to or need to earn more profits to attract third-party private capital to replace the government's current stake. And the other way is that agency MBS investors lose faith in their backing. And they start to see credit risk returning to the securities, and therefore they demand a larger premium over treasuries, and that translates into higher mortgage rates.
What does it mean exactly when you say that the U.S. has a stake in these companies? Because, I go to HDS on the Bloomberg terminal to look at these equities to see who the holders are. It doesn't say the U.S. government owns X percentage of these firms.
Yeah, so actually at Bloomberg we do an interesting thing, which is that we display the share count as though the Treasury had already executed its warrants. It holds warrants to buy 79.9% of the common stock, but they're not actually exercised yet. So the federal government is not reflected as an owner of the common shares. What they do own is something called the senior preferred shares, which obviously, as the name implies, are senior to the common shares. And the valuation there is something called the liquidation preference, which is growing each quarter equal to the amount that the companies earn, and it's approaching $400 billion. So that's kind of the biggest impediment to this recap and release process that you hear about, is what does the federal government do with this gigantic stake in the companies, and how does it get paid back?
Yeah, because I wonder, if the government is still somehow involved, is it kind of a sure thing for investors? Maybe not a high flyer, but a sure thing. And I also do think about moral hazard. If something goes astray, do we just assume the government's going to be there to protect things.
Yeah, I think there's the biggest risk is obviously moral hazard, right?
Right.
If they leave conservatorship and there's a defined dollar amount that the Treasury agrees to backstop the companies, and they pay for it, I think even then bond markets will assume that if worse comes to worst, the federal government is going to write a blank check. The companies are absolutely fundamental to the U.S. economy, and if they were private enterprises, there's just no way that they could, go into bankruptcy and be resolved simply. And the evidence of that is 2008, right? It's staring us right in the face. So it does seem as though there's some circular logic here,
Right.
like we'd be going right back to where we were.